The Intelligent Investor, a Bible for all investors. The Intelligent Investor, written by Benjamin Graham in 1949, is possibly the most important and influential value investing book ever written. A Bible for all investors, it made the concept of investing simple and easy to understand, so that even an ordinary individual could become an intelligent investor. Graham's work influenced many successful investors, including Warren Buffett, who considered him a significant figure in his life. His books remain influential. While some of his specific methods are less applicable today, his core principles of value investing and the margin of safety are still widely followed. Historically, investment opportunities were more restricted and primarily accessible to wealthier individuals and institutions. To be successful, investors need to possess several key traits and strategies, with luck, marketing knowledge, patience. However, the financial landscape has significantly evolved, and thanks to digital platforms and fintech innovations, investment opportunities are now much more accessible to a wider range of people, regardless of their income level. Newton, despite his brilliance in science and mathematics, experienced a significant financial loss during the South Sea Bubble of 1720. This event serves as a reminder that even the most intelligent individuals can make poor investment decisions, particularly when emotions and herd mentality take over. "I can calculate the motions of the heavenly bodies, but not the madness of men," is a remark reportedly made by Newton. In summary, while Newton's financial loss during the South Sea Bubble did not ruin him, it offers a valuable lesson. Even brilliant minds can be affected by the allure of speculative investments and the dangers of herd mentality. Graham asks the reader to imagine that they are one of the two owners of a business, along with a partner called Mr. Market. The partner frequently offers to sell their share of the business or to buy the reader's share. This partner is what today would be called manic depressive, with their estimate of the business's value going from very pessimistic to wildly optimistic. The core message and highlight of Benjamin Graham's The Intelligent Investor can be encapsulated in the concept of value investing and its emphasis on rational decision-making and a long-term perspective. Focus on intrinsic value. Graham argues that an investor should analyze the intrinsic value of a company based on its assets, earnings, dividends, and future prospects, rather than being swayed by fluctuating market prices. Value investing is about buying stocks for less than they are truly worth. Value investing explained with a simple example. Imagine you're buying a used car. You wouldn't pay the same price for a 5-year-old car with 100,000 miles as you would for a brand new one. Would you? A margin of safety is the difference between the intrinsic value of a stock and its market price, as how much output or sales level can fall before a business reaches its break-even point. Example: if a company's expected sales are $500,000 and its break-even sales are $300,000, its margin of safety is $200,000. Graham stresses the importance of emotional control and discipline in investing, as emotions like fear and greed can lead to poor decision-making. He distinguishes between investing and speculation. In investment, purchase an asset, security for securing stable returns. In speculation, executing a risky financial transaction with a hope of profit-making. Time horizon, highlighting the dangers of speculation driven by short-term market trends rather than fundamental analysis. The intelligent investor develops a rational plan and adheres to it, resisting the urge to deviate based on short-term market fluctuations or emotional impulses. In his book, Graham describes investors as belonging to two investment styles. One is defensive investor, and other one is enterprising investor. A defensive investor is someone who prioritizes capital preservation and aims for satisfactory returns without dedicating excessive time or effort to investment research. They tend to be more risk-averse and prefer stable, low-volatility investments. Their investment decisions are often guided by a desire to avoid losses and generate modest, consistent returns over the long term. Defensive investors typically diversify their portfolios across different assets, sectors, and geographical regions to spread risk. Example is a retirement investor who consistently invests in a mix of diversified stock and bond funds, prioritizing long-term growth and capital preservation without actively trying to pick individual stocks or time the market. An enterprising investor is willing to dedicate more time and effort to researching securities with the hope of achieving better returns than a passive approach. They are more active in the market, seeking out undervalued opportunities and engaging in deeper analysis to make strategic investment decisions. While seeking higher returns, enterprising investors are still focused on managing risk and maintaining a margin of safety. Exercises emotional discipline to avoid impulsive decisions based on market fluctuations. Example: Warren Buffett, a famous student of Benjamin Graham, embodies the enterprising investor archetype. He conducts thorough research, analyzes financial statements, and focuses on long-term value creation rather than short-term market fluctuations. The distinction between defensive and enterprising investors highlights the importance of aligning investment strategies with individual goals, risk tolerance. Defensive investors prioritize safety and convenience, while enterprising investors seek higher returns through active management and in-depth analysis. Ultimately, both approaches can be valid and successful, depending on the individual investor's circumstances and preferences. The Intelligent Investor teaches a timeless approach to investing that prioritizes preserving capital, making informed decisions based on intrinsic value, and maintaining emotional discipline in the face of market fluctuations.